Good morning, folks. Welcome back. Happy Friday. We made it, but markets are looking a little bit down in the dumps this week. We're actually looking at the last 2 weeks have been basically the worst period for U.S. equities, U.S. stocks since March, basically. So we're seeing, a little bit change in sentiment, a little bit of folks taking chips off the table. You've heard me mention this before that the more speculative investors, institutional investors in the market, like hedge funds, have been pretty short, meaning that they're expressing that they think that US markets are going to correct, that some of these companies that have done exceptionally well this year are going to come down. And we're also seeing some weakness globally, right? We talk a lot about China on here. China just got a refresh report from Nomura, a Japanese investment bank. Take that with a grain of salt, but indicating that they expect China's growth rate, their GDP, their macroeconomic growth rate, to slow down significantly, quoting it around 4%, which is about half of where China's government believes that their growth rate needs to be to sort of sustain the quality of life, to sustain the improvement of their GDP growth, of their economic development, of the GDP per capita growth. Because one of the most important things that China wants to accomplish in this generation, in this multi-decade era of growth, is to develop a strong domestic consumer economy, much like the United States, right? The consumer throughout the last 2 years in the US has been the backbone of keeping us out of a recession, of keeping growth strong, because Americans are used to going out and buying what they want, buying what they need. They have great jobs that pay well for the most part. We have extremely high employment in the country. And when there's a little bit of gloom and doom in the air, Americans don't just cut up their credit cards and stop spending money and hoard cash under their mattress. Maybe during the Great Depression here in the 30s, that was the case. It certainly was, but now it's not. We have a very intense and powerful consumer economy that goes out and buys iPhones every year, and that really buoys our businesses, our local economies, restaurants, cafes, dry cleaners, etc. And then it also puts pressure on employers to keep salaries high because the consumer expects to be well paid so they can live an American lifestyle. And so that's been a major struggle for China. And the question that I've been asking myself in recent history is this good for the US? So on one end, right, seeing that the Chinese economy is not out there consuming and boosting the economy, there's a lot of debt defaults. A lot of people aren't paying their debts. A lot of businesses are failing because of debts. Banks are failing. Real estate projects are failing. And since China is such a centrally controlled place, there's not too much confidence as to will that be corrected? Will the banks self-correct? There's kind of a point where people throw their hands up and they're like, I don't know who's in charge, because the government typically steps in and fixes everything. And also is sort of this shadow hand over these entities. So as well, the Chinese populace is simply not schooled into becoming a strong consumer economy. Only one generation, maybe 1.5 generation of Chinese citizens has really entered this more comfortable, more modern, more economically liberated lifestyle. Previous generations, went through Maoism, went through the Great Leap Forward, went through a slew of horrendous steps that the country had to take in order to sort of lift itself up post World War II. So that's a big concern. Everyone's looking at China, worried about their growth rate, worried about what the impacts will be. On the other hand, I think that's a piece that has helped inflation on a global basis, right? Because if China doesn't have this intense global demand, doesn't have issues, placing people into labor roles, is still able to sort of produce and manufacture things, this could be a point that's keeping prices lower. Additionally, if China's not growing so strong, they have, over the last decade in particular, have been the largest buyer of commodities in the world, if not one of, depends on what category you look at. So China's always been out there buying metal, buying oil, buying construction materials, base materials. And so if there's an economic slowdown going on there, we can see that temper back, and that translates into cooler prices, which helps cool off inflation here in the West and keeps us in a nice, comfy economic state where we're growing at the rate that we're supposed to be growing. So that's my bit on China that I was going to touch on this morning. And it leads me to, another nexus here in the US where there's a little bit of friction between the state, between the businesses, between taxation and regulation, and that's Puerto Rico. I mean, this has been in the news cycle for years now, especially post COVID. Puerto Rico is a tax free region in the United States. It's not officially a state, it's a territory, but it is tax free. And it's come up in the news over the past several years, both on, what's the status of this US territory? What are the tax rules? How do they benefit locals? How do they benefit newcomers? And then we've also seen a lot of infrastructure and natural disaster crises hit Puerto Rico. So it's this magical place. There's no taxes, there's bad infrastructure, there's a lot of suffering, a lot of poverty. But through COVID, it's become this weird, almost Mad Max anarcho-capitalist island in the middle of the ocean. We've seen tons of hedge fund managers move there for the tax advantages. And with them comes a lot of wealth. So they go there, they build mansions, they set up generators, and they're able to kind of cancel out the infrastructure and environmental issues for the most part, save a boatload of cash and taxes. And on one end, it's brought some activity to the island, some business, some growth and some respect, but we're dealing with a classic thing that occurs in islands. This is also something that we've seen in Maui. My tragedy that happened in Maui with the fires in Lahaina, it makes me unbelievably sad. I've spent quite a bit of time there, especially when I was younger, and it's a beautiful place. And we're going to try and see what we can do to help out, maybe kick off a fundraiser. But in Puerto Rico, we're seeing that same phenomenon where investors, outsiders are coming in, driving prices of real estate up, driving costs of good up, and displacing some of the locals. So keep your eyes on Puerto Rico. I expect there to be maybe some changes in legislation. In fact, the tax dodging people that go to Puerto Rico might even be the catalyst that gets Puerto Rico made into a state or something along those lines, because the government wants to capture that tax revenue there. So, we're seeing some points of friction, not just in places like China, but we're seeing kind of these points of friction between the state, taxation, banking, economics, local law here in the States as well. So I will be eagerly watching the hedge funds who are mostly short the market as they kind of navigate the Puerto Rico environment. And last but not least for this morning is WeWork. So WeWork's been all over the news almost for the last 5 years, certainly through the COVID era, trading at 12 cents per share. To exist on the New York Stock Exchange, you have to be valued at greater than $1 per share. Now, typically share price is kind of meaningless, but in this case, it certainly is. I mean, if they can't even exist within the New York Stock Exchange index, they have big problems. WeWork is out there. They've announced that they're doing a 40-to-1 reverse stock split. What is that? So a normal stock split, let's call it 2-to-1. If you own 100 shares of a company that are worth $100 each, and a company announces a 2-to-1 stock split, you will overnight suddenly in your brokerage account or your 401k or wherever you own stocks, you will suddenly be given 200 shares as opposed to 100. So they'll take your 100 shares, they'll give you back 200, but each share will now be worth 50. So the market value of your holding is exactly the same, but you now own significantly more shares in the company. Bear with me. WeWork is doing the complete opposite of this. So they are taking your 100 shares and they are giving you back 50, but each share is now worth more. So it's kind of an artificial inflation of their share price. In this case, they're doing 40-to-1. So if you have 40 shares, WeWork takes them, gives you back one share at the same market value. This is, kind of a management slash, public company trick to consolidate the value of their shares. It's a move possibly to try to stay in the index so that they have access to the market and liquidity and people who want to bet on WeWork. But fundamentally, and they announced it in their previous earnings, we covered it here, they are very worried existentially whether they will be able to operate as a company. By comparison, and if you saw the WeWork film, they even showcase some of the other co-working spaces like Industrious HQ. So Industrious HQ actually is a similar business, but they don't actually take on the leases or ownership of any properties. They basically come in like a property manager for co-working. People are familiar with property managers when it comes to maybe some condo buildings where, the real estate is owned by a group, but there's a separate management company that handles the Wi-Fi, the access to amenities, the security, the mail. And so the owners of the property, either through the rents of the individuals or through their own business, they pay the management company to make sure that the building is operating well, and people want to live there. Industrious does a similar thing, but for co-working spaces. So they basically do WeWork's job, but they don't own any of the risk or liabilities of leases or actually owning the buildings. They've always kind of, especially for the last several years, through the entire WeWork saga, Industrious has been kind of this like janky kid brother that no one really cares about. But I've always kind of looked at them like, it seems like they're taking things very slow and steady. They're in a very curated way, trying to execute this very well. I know in the film, the Industrious HQ CEO gets kind of clowned on, gets kind of dunked on by who, our barefoot, long-haired WeWork CEO. So listen, they're in crisis. This is where management teams within public companies shine, when they can either navigate through a crisis and turn around or pivot or convince the market that there's something here, or they fail and we go into, bankruptcy proceedings and some pretty harsh outcomes. I mean, there's plenty of people still working at WeWork, so we'll see how that ends up materializing. But that's it, guys. That's what I have for the week. We'll catch up this weekend. I'll be putting out some new and fun stuff. We've got some like short form content coming out. Should be fairly fun. I'll make a complete fool of myself on like YouTube Shorts or TikTok and stuff. So you should see that kind of info flowing. And we have some portfolio updates going to be publishing on Qualcomm on our research site over the weekend. Stay tuned. Lots happening in the markets. We're entering September. Summer's over, and this is when management teams make serious decisions. Most of earnings, most of the revenue that especially consumer companies capture in the US happens in Q4. So stay tuned. Lots of action coming soon. Have a great weekend, everyone. Feel free to chime in on the Discord or ask any questions or get in touch with our team. Take care, guys.